Hello everyone. In week 4, we are going to cover income statement. Specifically, we will learn about the components and formats of income statement. We will also learn about the different accounting issues related to revenue and expense recognition, inventory, depreciation, and non-recurring items. We will also develop an understanding of EPS calculations and its use and significance. Finally, we will learn about income statement analysis using different financial ratios and other measures. Income statement is also known as the statement of earnings, or statement of operations, or profit and loss statement. As we know that revenues and expenses are reported in the income statement. So the net income, which is also known as the bottom line, is the revenue minus expenses. Revenue refers to the amounts charged and are expected to be received for the delivery of goods or services in the ordinary activities, or, as we know, the ordinary course of a business. Net revenue, on the other hand, means revenue that is reported after adjusting for cash and volume discounts or for estimated returns from customers. Revenues may be called sales or turnover. However, there is a difference. Sales is sometimes understood to be referring only to the sale of goods, whereas revenue can include both the sale of goods and the sale of services. However, both the terms, as we know, are used interchangeably. There are variations in the use of terms across countries. For example, in the United Kingdom and South Africa, the term turnover is used to refer to revenue or sales. Expenses refer to the outflows, depletion of assets, and incurrences of liabilities in the course of the activities of a business, that is, in the ordinary course of a business. Net income also includes gains and losses, which reflect the increases or decreases in economic benefits respectively, which may or may not arise in the ordinary activities or the ordinary course of a business. For example, when a manufacturing company sells its products, these transactions are reported as revenue, and the cost of sales incurred to generate these revenues are reported as expenses and are presented separately in the income statement. On the other hand, if the manufacturing company sells surplus land that is not needed, the transaction is reported as at a gain or at a loss. The amount of the gain or loss is reflecting the difference between the carrying value of the land, that is the book value of the land, and the price at which the land is sold. The definition of income includes both revenue and gains, and the definition of expenses encompasses expenses that arise in the ordinary activities of the business as well as losses. Based on this, the second equation here is an expansion of the first one, where revenues also include other income and gains, and then it deducts losses also in addition to expenses to arrive at net income. In addition to presenting the net income, income statement also presents the subtotals and other items that are significant for the users of financial statements in developing their understanding of the income and expenses of the company. One such subtotal is the gross profit, which is revenues minus the cost of sales. When an income statement shows the gross profit subtotal, it is called the multi-step format of income statement. When it does not show and excludes gross profit as subtotal, it is called a single step format of income statement. Another important subtotal in the income statement is the operating profit or operating income, which is obtained from deducting operating expenses such as selling, journal and administrative expenses, as well as research and developmental expenses from the gross profit. Operating income or profit is a measure of company's profits on its usual business activities, that is the ordinary course of business, before deducting taxes as well as interest expenses for non-financial companies. For financial companies such as banks, interest expense is an operating expense because that is their main operating activity. For some companies that are composed of a number of separate business segments such as Tesco and Sainsbury, Operating profit can be useful in evaluating the performance of the individual business segment. This is because interest and taxes expenses may be more relevant at the level of the overall company rather than at the individual segment level. The specific calculations of gross profit and operating profit may vary from company to company, and the reader or user of financial statements can consult the notes to the statements to identify significant variations across companies. Sometimes operating profit is referred to as earning before interest and taxes, that is EBIT. However, keep in mind that operating profit and EBIT may not be necessarily the same, because interest and taxes do not represent the only differences between net income or net earnings and operating income. Expenses may be grouped and reported in different formats subject to some specific requirements. Some of the items are specified by IFRS, but other items are not specified. Certain items such as revenue, finance costs, and tax expenses are required by IFRS to be separately presented on the face of the income statement. Additionally, IFRS also requires that line items, headings, and subtotals relevant to the understanding of the entity's financial performance should be presented even if not specified. Expenses may be grouped together either by their nature or function. For example, grouping together expenses such as depreciation on manufacturing equipment and depreciation on administrative facilities into a single line item called depreciation is an example of grouping by the nature of the expense. On the other hand, grouping by function would be grouping together expenses into a category such as the cost of goods sold, which includes all the expenses related directly to the sale of the goods. We have the first example of an income statement format for Colgate-Palmolive company here, and we can see that it is clearly presented in a multi-step format where we see gross profit being calculated after deducting cost of sales from net sales. And of course, net sales here represents the sales that are adjusted for cash and volume discounts or any sales return. And then we see selling, general and administrative expenses being deducted, and other income and expenses have also been adjusted here. Deducting selling, general and administrative expenses and other income or expenses adjustment from gross profit results in operating income, and that operating income is then adjusted for interest expenses, which has the word net in front of it, which means that this is adjusted for interest income. So the amount here represent net interest expense, which is adjusted for interest income if any. Deducting net interest expense from operating income results in income before income taxes, which is then adjusted for provision for income taxes, which results in net income including non-controlling interest, and then it is adjusted for net income attributable to non-controlling interest, and that results in net income attributed to Colgate-Palmolive company, and this is then used to calculate the basic and diluted EPS. Non-controlling interest, as you know, represents the income attributable in subsidiaries companies where minority shareholders also have shares. The second example is from the L'Oreal Group's income statement, and again it is similar to what we have seen for Colgate-Palmolive company, and it's presenting its income statement in multi-step format. The third example is of the income statement of Procter & Gamble, and we see that this company here does not reveal its gross profit as it is following a single step format where net sales have been adjusted for cost of products sold and selling, general and administrative expenses to arrive at operating income, which is then adjusted for interest expenses and other non-operating income, which is here 202. This is why we were considering that operating income should not be equated with EBIT all the times, because there are other items in addition to interest expenses as well as taxes that may be adjusted in operating income. In addition, we see that the company has presented its earning from continuing operations as well as the net earnings from discontinued operations. These have been then used to calculate the basic and diluted EPS from continuing operations as well as discontinued operations. This information is important for the users of financial statements to analyzing the present and past performance as well as future predictions of earnings and performance overall. Next, we understand the general principles of revenue recognition and accrual accounting as per the International Financial Reporting Standards as well as the US GAAPs. Before we go forward, please note that in May 2014, the International Accounting Standard Board and the Financial Accounting Standard Board converged the revenue recognition standards, which are the IFRS 15 related to revenue recognition from contract and the FASB ASC topic 606, which also deals with revenue recognition from contracts. So the discussions here we are having are deriving mostly from the core textbook, and we will stick to that, but I'll also introduce the new changes after the conversions from May 2014 standards. A fundamental principle of accrual accounting is that revenue is recognized and reported in the income statement when it is earned. So the company's financial records reflect revenue from the sale when the risk and reward of the ownership is transferred. This is often when the company delivers the goods or services. Hence, revenue recognition can occur independently of cash movements. If the sale of goods or service was on credit, revenue is recognized and a related asset such as trade or account receivable is created. For example, here we will have the entry as account receivable debit and sales credit. Later on, whenever cash is received from the account receivable, so cash will be debited and account receivable will be credited. And we see that there is no mention of revenue in the second entry. It is recorded in the period in which it is earned. This is also consistent with the matching principle, where revenue should be recognized in the period in which it is earned. Similarly, when cash is received in advance of providing the goods and service, a liability in the form of unearned revenue should be created and cash debited. For example, here the entry would be cash debit and unearned revenue credit. Later on, when the revenue is earned and the goods or service is delivered, the entry should be liability unearned revenue debit and sales or revenue account credit. Before the conversion of the financial reporting standards between IFRS and US GAAPs, the IFRS used to require 5 conditions that must be met to recognize revenue. These included the following. 1. The entity that is selling the goods or service has transferred to the buyer the significant risk and rewards of ownership of the goods. 2. The entity selling the goods or service retains no continuing managerial involvement with or effective control over the goods sold. 3. The amount of revenue from the sale can be measured reliably. 4. It is probable that the economic benefit associated with the sale transaction will flow to the selling entity. And number 5, the cost incurred with respect to the sale transactions can be measured reliably. These conditions imply that the seller bears no risk with respect to the goods sold. In case the goods are destroyed by fire, it will be a loss to the purchaser and not the seller. Similarly, the seller cannot tell the buyer what to do with the goods, as the seller has already sold them to the purchaser. The seller knows what amount to collect from the buyer and is reasonably certain to collect the amount from the buyer, as well as the seller also knows how much the goods sold actually costed. Before the conversion of revenue standards in 2014, the IFRS noted that the transfer of the risks and rewards of ownership normally occur when goods are delivered to the buyer or when legal title to the goods transfer. However, as noted by the remaining conditions, physical transfer of goods will not always result in the recognition of revenue. For example, if goods are delivered to a retail store to be sold on consignment and title is not transferred, the revenue would not yet be recognized. Previously, IFRS used to specify similar criteria for recognizing revenue for the rendering of services. However, changes have been made to revenue recognition in the Converged standards issued in May 2014 by the International Accounting Standard Board and the Financial Accounting Standard Board. In the case of the US GAAP, before the Convergence standards in 2014, the US GAAP used to specify that revenue should be recognized when it is realized or realizable and earned. The US Securities and Exchange Commission provided the guidelines on how to apply this accounting principle. The guidance provided 4 criteria to determine when to recognize revenue, that is, when revenue is realized or realizable and earned. These 4 criteria were: there is evidence of an arrangement between the buyer and the seller, the product has been delivered or the service has been rendered, the price is determined or determinable, and the seller is reasonably sure of collecting money. The first criteria will ensure and disallow the practice of recognizing revenue in a period by delivering the product just before the end of an accounting period and then completing a sales contract after the period end. The second condition would preclude revenue recognition when the product has been shipped but the risk and rewards of ownership have not actually passed to the buyer. The third condition would disallow a company recognizing revenue that is based on some contingency. The fourth condition would preclude a company from recognizing revenue when the customer is unlikely to pay. Now we review the converged revenue recognition standards that were issued by the International Accounting Standard Board and the Financial Accounting Standard Board in May 2014. According to these converged revenue recognition standards, revenue should be recognized to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in an exchange for those goods or services. Specifically, the converged standards identify 5 steps to revenue recognition, and these steps mostly relate to revenue recognition from contracts, for example, such as construction contracts. However, these are equally applicable to other situations for revenue recognition. Number 1, identify the contract or contracts with a customer. Number 2, identify the separate or distinct performance obligations in the contract. Number 3, determine the contract price. Number 4, allocate the transaction price to the performance obligations in the contract. And number 5, recognize revenue when or as the entity satisfies a performance obligations. Now we will be talking about completion methods for contracts later and how to recognize the revenue in different situations. So we will be describing these and will develop an understanding of these. Then the standards also describes the factors to consider while assessing that the revenue should be recognized, as the condition to revenue recognitions have been met, which focuses on satisfying the performance obligation by transferring the control to the customer. And how would we assess these? So there are 5 factors that have been identified to assess whether the customer has obtained control of the asset at any point. The first one is that the entity has a present right to payment from the customer. Number 2, the customer has legal title, and that is the title to the ownership of the asset has now been transferred to customer.
the customer is also in physical possession of the asset or the goods. Number 4, customer has the significance, risk and rewards of ownership. And number 5, the customer has accepted the asset. So these are the 5 factors that will be considered while establishing that the customer has obtained control of an asset, and in that case revenue will be recognized. In the next tutorial, we specifically cover different revenue recognition applications.